chance to reflect the week in review and look to the week ahead. Today is Sunday, May 16th, and it's 2 weeks into the month in which OPEC Plus have officially declared that they are raising supply by 700,000 barrels a day this month, next month, and July. Let's kick off with Christoph Ruhl, sitting in Germany, senior research scholar for the Center on Global Energy Policy at Columbia University. Christoph, despite all the turbulence last week, prices managed to slightly sustain an increase as they've done over recent weeks. Your thoughts on reflections from last week?
I thought the turbulences were important and they will continue in the weeks ahead, because essentially what we have seen on the economic front is contradictory messages. We had this very, very disappointing labor market support from the US coming out the previous week, and everybody wondering whether the recovery is slower than expected, and thereby oil demand growth slower than expected. And then we had inflation data coming out, and they were a bit stronger than expected. Still relatively modest, but 0.8% month on month, if you add it up for 12 months, would be quite something. So that would indicate that the economy is actually moving ahead a little bit faster. And I think that kind of picture will continue, driven by the biggest economies, that is the US, and then with China. And of course, it will be dominated by data from the US because they publish more data faster. But then also on the sidelines, we'll see the Biden administration continuing to move fast on international and global politics. So the deal with Iran, which may be resumed and already casting shadows ahead on oil markets, the outbreak of violence in the Middle East, in Israel, and in the occupied territories where nobody knows whether that spills into a certain direction or into bigger hostilities, derailing the kind of detente which we have seen between Saudi Arabia and the UAE and one side and Israel on the other. So as COVID disappears, the normal ugly geopolitics and disruptions from that end are raising their heads too. And then finally, let me just mention it, not to steal too much time, maybe we can discuss it later. It becomes more and more important to distinguish the kind of bottlenecks and disruptions which we have in the global supply chain between what are genuine supply chain bottlenecks, we can talk about a little bit, which I think the system is very well equipped in handling. So our market system is great in fixing supply chain problems, and problems which are coming from excess demand, from the beginning of overheating of the economy, from asking too much from a supply chain which is too small. And these are the problems which will usher in inflation if it ever comes. And it will be a very hard task for the markets and for the central banks to figure out exactly what is what, but the result will also be important for oil. With all that choppy waters, I think, and the good job OPEC Plus has done in stabilizing the supply side, I think we are in for a prolonged period, as I said earlier, where we should understand prices between 60 and 65 to be an anchor, a center of attraction, a point of attraction, fluctuations around it. The bigger the deviations, the stronger the forces to bring it back, including the political forces of OPEC Plus. The closer in that range, the less movements we should expect other than from external disturbances.
Let's welcome Adi Imsirovic, Senior Research Fellow at the Oxford Institute for Energy Studies. Adi, I was enjoying reading your monthly report and took note that the Oxford Institute, as its top item on the monthly report, was bringing US shale back into focus. I'd welcome your comments on that, and also your thoughts on the point that the bottlenecks, as was referenced by Christoph, regarding the situation in the US last week. Perhaps the biggest story of the week was the closure of the Colonial Pipeline.
Yeah, good morning, Sean. Thank you very much. Yeah, I mean, first of all, I just want to step back. I would agree with Christoph that last week was really about macro situation, and I think that was pretty much driving the market. Well, we'll probably come back to that a little bit later on. And as we go along this year, I think shale is definitely coming back into the picture. It's becoming more and more important, especially as we see the rig count slowly creeping up again. Our projections for this year is that we are actually, by the end of this year, we are going to go somewhere up to about 600 rigs again, which is not far below the sort of 1919 levels, just a touch below. So I think we're slowly seeing shale becoming very, very important. This year, we don't think it's going to make any impact to make a difference for the prices. As far as OPEC Plus is concerned, they can probably sleep rather well. But I think next year, we think that it's definitely going to come back as a thorn in the side of OPEC Plus, and they'll start to worry about that quite significantly. Obviously, the prices are the key assumption for that. Our assumption is actually very modest. We are talking about $60, just over $62 Brent, $60 WTI. If we see higher prices as we see now, which we still think that sort of on the high side for the year, we will see even bigger supply. So I think it's coming back to be a problem again.
On the point of the Colonial Pipeline, Adi, it was a rather strange story last week. I mean, it ended up prices rising because the pipeline was back in business rather than the other way around. It just seemed the market really didn't know how to digest it from a macro crude point of view.
In a big picture, it's sort of market neutral, but in the short run, is a knee-jerk reaction, obviously, because you have to rush supplies from elsewhere, and obviously from Asia and Gulf, you're rushing Europe, you're rushing gasoline. This whole idea of Jones Act is really a joke. I can't believe that U.S. legislators are not dealing with that, because now we see, even in the winter, we see LNG coming from Russia into Boston Harbor, just because you can't bring it from the U.S. Gulf. But I'll leave that to the Americans to sort out. But certainly in the short run, it did appear slightly bullish. But of course, now as the situation is going back to normal, you will, if anything, see slight overhangs internally. But yeah, I mean, it certainly was a very interesting situation from many other political, geopolitical, and other sort of.
I mean, the cyber vulnerability itself, I mean, is a huge subject, and one in which clearly is going, has already been an issue. Just also at the end of last week, completely not connected to our space, but the Irish healthcare system was attacked by a similar cyber attack, and they had to shut down a big part of the health system.
But very, very important, Sean. I want to underline the other thing about this pipeline is we have so much pressure in the United States and elsewhere not to build new pipelines from an environmental point of view, and yet you see the risks of relying on one very, very large pipeline. So
it does seem like an incredible vulnerability, bottleneck, as Christoph mentioned. Christoph, obviously last week inflation raised its head everywhere and came big into the debate about further stimulus. 18 US states are going to now, on the back of this, it would appear, to cancel the welfare boost that they've been giving to unemployed people. 18 states, by the way, that are run by Republicans. But nonetheless, it shows you where that fault line might be going forward.
I don't know if they will cancel it, if they can afford to do this, and if they're even legally entitled to cancel that. So this I just don't know. But in terms of this inflationary pressures, yes, we have said that for quite some time. The thing to keep in mind is we have two categories of bottlenecks here. So we have, on the one side, for example, number one, disruptions from Corona. So here again, our famous house building story. Now we can't get some plates to fix the ceiling because the packaging material is not there, because it's produced by a factory in Belgium which has been closed. Or my daughter is missing the little plastic animals in the store. They're not there because they come from a factory in Portugal, which has. These are clearly understandable Corona-related shortages.
Right.
Then there are trade bottlenecks when containers pile up on one side and not the other, because there's a lockdown somewhere and they cannot be unloaded or they cannot be filled. So that's the kind of stuff which is supply side bottlenecks proper, which the system is well to adjust, will be doing well to adjust. But then there are two other categories and they become more important. One is the escalation of simple disruptions. You're all aware of the shortage of semiconductors in Europe, which led to short labor in some car factories. Turns out 75–80% of all semiconductors come from one country. And so that will then, if it takes longer, escalate into other sectors of the economy. Somebody doesn't get his truck, so he can't continue his business. So something doesn't get delivered, and so on it spreads. So escalating bottlenecks are dangerous because they are not temporary. And then we have things which are already more or less related to monetary policy, believe it or not. There, I'm sitting in the middle of the Black Forest again. You cannot get lumber for construction. Everybody in Germany complains there's no lumber for construction. Why not? Because it's shipped to the US. Why is it shipped to the US? Because there's a housing boom, and US houses are made with wood frames. Why is there a housing boom? Because interest rates are close to zero. You know? So this kind of thing is what we are looking for. And the indicators, I think, to watch out for is the point in time when it spreads from producer prices into consumer prices, and you can no longer say, okay, container rates go up. What do I care? My goods are still the same. And when a temporary problem becomes permanent, and more importantly, and most importantly, I would argue, when it spreads from product prices into wages. When you have a situation where somebody gets higher wages because he thinks everything gets more expensive, then some other sector looks at that sector and says, hey, these guys have a 5% surcharge, I want them too. And with this wall of money around, this is those economists who have warned us of that are right. It's a real danger. It's not for now. Again, it's not for the summer. This is mostly about the correction of supply disruptions. But it will probably, I would think it will be with us starting in the fall, if the recovery goes well. See, that's the bad irony here. The better the recovery, the bigger the problem. That inflation.
The other story last week, IEA reporting and the EIA, that essentially the global oil glut from last year has now been removed. Your thoughts on that and its implications for where the market moves going forward?
I think I agree with what I said before. Shale, the big picture problem has not disappeared. Shale at these prices will come back. And it will come back financially restructured, it will come back with different ownership structures, it will come back with better returns, it will come back stronger and more resilient than before, but probably just as able to react quickly. And against that, when you look at the inventory game, so I think this is correct, inventories have eroded. You could criticize that they should look not at the time after 2016 as an 2016 to 20 or 15 to 19, because that was a period of very high inventories after the collapse in prices in 2014. But even if you take a previous 5-year average, they're coming back to normal. That's not where the music plays anymore. The focus needs to be now on spare capacity. And spare capacity of a voluntary kind is exclusively held in the OPEC countries and is still large. So their steps in reducing more and more oil into the market and reducing their own spare capacity, that's the most crucial thing to watch. And spare capacity in a funny sort of way, in an indirect way, are also in the shale sector, of course. DUCs, the drilled but uncompleted wells, are plentiful. Lots of people could produce at these prices and are sort of slowly finding their way back.
Well, as you say, spare capacity in OPEC is also 2 million barrels in the US. Adi, on that point, do you take the IEA guidance of we're down to the 5-year average? What does that mean, do you think, for the outlook of the markets and what OPEC policy should be?
Well, it's quite positive. Apart from the numbers that we are, I think roughly off the top of my head, I think OECD as a whole is about right at the top end of the 5-year average. At the same time, US is actually at the lower end of the US of the 5-year average. As Christoph says,
actually said it's slightly below.
Yes, exactly. But in terms of what we need to look at is in terms of days of coverage. In the US, actually, yes, the stocks are actually a lot lower than earlier on. So we're talking about, I think, about 32 and a half days coverage. So the stocks are certainly have normalized quite a lot, which is expected when your demand suddenly picks up. In this year, we're expecting demand up 5.5, maybe even 5.7 million barrels a day. That's a lot of oil suddenly demanded in the market. All the signs are, I mean, we see stocks in China as well. Obviously, stocks in China, we calculate them as implied stocks. We don't have proper data, but we see stocks sharply down at the moment in April compared to, say, Q4 last year and so on. We see a lot of buying from the independent refiners coming in simply because they have to restock, coming back from turnarounds and so on. So demand is certainly very, very good. In terms of OPEC Plus, again, it's a difficult one, Sean, a difficult one because of COVID again. We haven't started yet about this Indian variant, but here in the UK, we feel it quite strongly because it's prevalent actually in the UK right now, the Indian variant. We don't even know whether the vaccines are effective. The city of Bolton is sort of shutting down because of that. We still have to wait and see. And there's a huge amount of uncertainty now. I think you had on your show early on last week, I think Vandana was talking about Southeast Asia. I think in Southeast Asia we have a pickup in number of cases as well. Boy, if that sort of translates into China, what happens then? So there's a huge amount of uncertainty. So for OPEC Plus, it's not easy at all. I think most likely, if they had to make a decision tomorrow, it would be just wait and see. But having said all of that, I wouldn't be terribly bearish in the short run. I think we still see prices in the mid 60s for this year, but we could see short-term Q3 as we're going into Q3, and we're already trading pretty much August sort of futures. I think we will see blips over $70 on the back of various sort of news as we see coming from the market.
Christoph, we're still seeing despite these issues, and obviously India being at the forefront of it, we are seeing U.S. aviation, for example, the last few days, the highest number since the COVID crisis, and ultimately up at about 1.7 million travelers a day in the U.S., which is in essence the leisure travel data point pre-COVID. And what's missing is the business travel, the rest of the piece, that the scope of more supply could be argued for coming from OPEC, which ultimately is only 700,000, not even that, half of that 700,000 per month is a Saudi unilateral increase. Do you think there is a potential call, as you said, the price sweet point is 60 to 65, that OPEC could afford to put more barrels on the market and still defend 65?
You see, potentially yes, but I agree again with Adi that you will see spikes, probably outliers both sides. So what we have on the demand side is two ways of looking at this. Just as you could say that's probably the strongest demand growth ever for any year, or you could say it's not quite where it was in 2019. But either way, it means that when you manage supplies to meet this demand with all these uncertainties, COVID-related, economic-related, that you have to be very nimble, very quick in adjusting. And yes, there may be phases where you should have more than 700,000 on the market. I bet you Saudi Arabia is very happy now that they have this additional flexibility of this additional million to play around with without big negotiations. But this will be used up very soon. So I would not be surprised.
A lot of it is for domestic consumption because of the summer season in Saudi Arabia.
No, these were export cuts. No? So,
okay.
But I think that they will. I would not be surprised if OPEC Plus would do the next best thing, which is to find a mechanism to adjust supplies if necessary quicker, rather than. I mean, monthly is already pretty good, I guess. But so their problem will be to watch demand and meander along, and then always make a series of right calls to get enough oil into the market without draining the system.
Let's get this survey question and give everybody a chance before we ask Christoph and Adi about the week ahead. Again, it's on this issue. The IEA has reported that the oil glut is gone, with global inventories returning to near 5-year average. Does this clear the way for OPEC Plus to increase supply beyond the planned 700,000 barrels a day approximately in May, another 700 in June, and then a further 700 in July? And that's, as we said, a combination of both the Saudi unilateral and OPEC Plus, and still protect $65 a barrel on Brent. So does this open the way for OPEC Plus to add more barrels and yet defend 65, the fact that we are now back down to the 5-year average? On that point, Adi, I mean, sort of central to that, whether it's OPEC Plus organized additional supply or not, but I'd like your comments on the outlook for the Iran deal. It does seem to be slowly but surely progressing towards an outcome that will see it reactivated, which will see Iranian oil sanctions, I presume, lifted. And with that, more supply slowly but surely. How does that play out, do you think, in the second half of the year?
Yes, quite important. One of the comments that I heard almost about a month ago, which I actually quite liked, was the fact that that the sooner that the Iran deal is done, the better, because the longer it goes on and drags on, the harder it will be actually to close. And I think personally, I think this is one of the issues that Biden would just like to put to bed, essentially. Now, in terms of the impact on the market,
I think it might be one of the reasons why he's being, sorry to drop, why he's being so quiet on the tragedy in Palestine and Israel is because of the vulnerability of the Iran talks. I don't know what the correlation exactly is,
it's
but
quite possible. It's rather complicated, yes.
yeah,
And I think there are better commentators on that than myself.
yeah.
But certainly, I think that a lot of the Iran supply is actually being priced into the market. And we know that a lot of oil was coming out anyway, primarily to China via Malaysia and transshipments. So the ability of Iran quickly to ramp up a lot more over and above what they have been exporting, which is about 1 million barrels a day, very roughly, I think is very low. So I think that the volume we're talking about is probably 250,000 barrels plus or minus. I think market will absorb those volumes, especially as given the circumstances. Christoph said, I think one of the smartest things that sort of the Saudis and the rest did was A, to have these more frequent meetings, B, to have this availability of what that 1 million that they can play around with. The nobody really is like it's like an ace in your sleeve. You can always pull it out and play with it. So I think that's really not a big issue. At the same time, you have a complication right now. China's just applied taxes from July, I think, on light cycle oils, including some bitumen products. That actually is the main way that some heavy Iranian and Venezuelan barrels have been smuggled into the country. So it'll be interesting to see how that actually impacts the imports of these barrels as well. So we haven't started that. It's a whole new sort of chapter, and we have to see what happens with that one. But certainly that actually may dampen some of the imports that were coming into China. So overall, I don't see, the bottom line is I don't see a big change in terms of market price and market expectations. It just makes the OPEC Plus job a little harder.
What about just on the point that we have a story on the digest today that maybe it's not more barrels that come from the Iranians, and maybe it will be slowly but surely, but that the competition for that quality of crude oil, that heavier crude, might create some market share challenges.
Well, absolutely. We have already, Saudis have actually dropped their OSPs for Asia. Already in that space, people are anticipating what is going to happen with slow easing of the OPEC volumes, and Brent Dubai has already reacted to that. Dubai getting a little bit weaker relative to Brent, going back to normal levels of sort of EFS about $3 a barrel. So certainly, that's one of the issues. I think for Saudis, actually equally important will be what happens with Iraq, because Iraq still being less compliant OPEC member, shall we put it that way. So that sort of competition situation with India was a very important market next door, which is most important sort of market to cover because of freight advantages. It will come back as OPEC increases the volumes coming into the market. That competition will become important. But we don't see that actually being important this year, maybe not even next year, because overall balances, assuming OPEC Plus keep their discipline, overall balances, I think, still are going to remain reasonably solid. If you look at the down the curve, Brent doesn't go below $60 until I think 2024. So we have a very solid floor to that market, and we do see market not going below 60 for quite some time.
Christoph, next week we're sort of seeing the opening up of Europe. The UK travel starts tomorrow. Germany announced last week some revisions to its COVID policy, allowing more travel in and out of Germany. All of these changes may define the market direction in the weeks ahead.
Yeah, they will. Let me add something to the Iranian situation. I think it's probably bit more of a threat to OPEC Plus, because it has two components. One is it makes, of course, the calculation more difficult. But if Plus is any guide, what you had in your digest, Iran has the capacity to ramp up exports, not production, by 600,000 in 3 months and by 1.2 million in 6 months, when they are starting to count from the time a deal is struck. That means it becomes massive, more important than Adi said, in the longer term only, so it becomes even harder to calculate. And the other component which plays into that when we talk about spreads is that at various destinations now, including India, it seems to, which has a big refinery system, it seems to be that the heavy end of the barrels, bitumen demand and all that, is collapsing first, so that you have this this imbalance within refining systems where there's too much heavy stuff around and not enough demand for gasoline, not to mention jet fuel. So this adjustment also will have some more minuscule impact, as you suggested, on OPEC. In terms of the outlook next week, we have inflation data coming in from several countries, including the UK. That will be very interesting in comparing it with what happened in the US. We have the end of the reporting season. At the end of the reporting season sees all the big retail shops reporting, so that in the US, you know, these big Walmarts and Home Depot and these guys. And that is important because if they have not done exceptionally well, then there's a suspicion, of course, that there's a temptation to increase retail prices, so people will be listening to that. We have oil and gas inventories, of course, which after the Colonial Pipeline are in the focus, and because of the OPEC Plus adjustment we discussed. And then we have the April data, on the US housing market, so on everything, housing starts, mortgage applications, stocks, inventories. That's probably the most important one, which gives some guide on, because the housing market is one of the potential starting points for inflation, to see whether this upward shift, which we saw last week, is durable or not.
Let's get the survey result and give Adi the last word. Yes, 2-1, there is capacity for OPEC to do more. Adi, what will you be watching in the coming week as you consider traveling again?
Yes, indeed. I think Christopher was right to start the whole conversation this morning with the macro. I think macro has been a driver for quite a bit of volatility in the market. And I would also end it with macro. I think the only thing I would add to what Christopher already said, we've got OPEC, I think, monthly report coming out early next week, Tuesday, I think. And the CPIs, actually, we have also Chinese CPI coming out, US CPI, PPI. And I think that will give us an idea, because I think what we saw on Friday, the market rally, in my opinion at least, was at least partly driven by the Fed talk of not basically Fed not being worried about inflationary pressures. And then that led to the whole macro just kept going back, and we recovered about 70%.
Seems to be now like a weekly statement the Fed has to make in order to keep the market calm.
Absolutely. So I think macro is going to be a big driver in the next week. So just watch these numbers: retail sales, CPI.
Do you think the upward momentum? I mean, we've stuck in this bandwidth, this sort of trading range on Brent in the 60s now, for all the different reasons we've talked about, that it could propel above 70, and yet it doesn't. Is there a lot of this recovery baked in this price already, Adi, do you think?
Well, I think there is. I think there is. And overall, what we are seeing right now is probably the market is trading on the assumption that Fed is not worried about so much about the inflationary pressures, at the same time that these new variants coming out of India are not terribly serious. So any additional news that you hear, I probably should have added, see what happens in the UK, because we're probably first on the firing line due to the population structure. How serious this Indian variant is. We have half the population have already received the first vaccine. So hopefully it won't be a big deal. But if it is a big deal, then everyone else should watch out and really pay attention.
Yeah, I think there's, and the interesting thing they announced in the UK over the weekend was to accelerate the vaccination of younger people in those vulnerable areas where the Indian variant may be present, and also in the US to vaccine under 18s as well. So clearly there are some concerns there and need to accelerate. They've announced it here as well to go under 18, under 16 12-year-olds to 16-year-olds have now been cleared for vaccination here. But that's certainly one to watch, where this Indian variant goes and where does India as a whole go. Hopefully things calm down there, and the spreading of that variant also calms down. But Adi, thank you so much for your time today. Christoph as well, really appreciate it. Have a great week, everybody. We'll catch up with you each morning. I am returning to the office this week. That's my big news. So I will have to learn how to shake people's hands, and I need those top 10 tips of meeting people. So that'll be an interesting change for us. All the best. Thank you.
Take care.
Look at the eyes, don't look at the camera.